Most people compare Roth and traditional retirement accounts by asking the simple question: what tax bracket will I be in when I retire? While that is an important question to ask, it's not the only one. Because depending on which account you choose, it can affect more than just your federal income tax. It can affect how much your Social Security benefit is taxable. It can affect how high your Medicare premiums are going to be. And it can affect how much control you have over your income later in life. So today, I want to break down the differences between Roth and traditional. And it's not as simple as pay taxes now versus pay taxes later. With a traditional retirement account, you contribute pre-tax. That means your contributions help lower your taxable income today. You get the tax benefit up front while your withdrawals in retirement are taxed at the federal income tax bracket that you're in. Whereas a Roth, you're paying the income tax on your contributions today, but when you are withdrawing those funds in retirement, that money is coming out completely tax-free, including all the growth. Now, you have to follow the withdrawal rules to make them a qualified withdrawal to get that benefit. Now, here's where the comparison gets really interesting. If your effective tax rate is the same when you're contributing to your retirement accounts as it is when you withdraw from your retirement accounts, mathematically, you pay the same amount in taxes and you end up with the same amount of money at the end of the year. The key is whatever tax savings you save by investing in a traditional account, you put that money into the investment. You increase your traditional investment by that amount. So, for example, say you had $10,000 today to invest and you want to know which retirement account to put it in. If you're paying an average federal income tax of 15%, you would put the full $10,000 into a traditional account and then pay that 15% when you withdraw. Versus with a Roth, you'd put $10,000 minus what you would owe in taxes of 15%, and you would have that money grow tax-free into a Roth and be able to withdraw it tax-free in retirement. It would be the same. You'd end up with the exact same amount of usable money in retirement. The key difference is understanding that your taxes, the tax code is very unpredictable. You don't know if laws will change, if the tax code will change and you'll be in a higher tax bracket in retirement. Right now, with the national government in nearly $40 trillion in debt and consistently running national deficits of nearly $1 to $2 trillion a year, my view is that I think they're going to have to eventually increase taxes. So that's one of the reasons I'm choosing to invest in a Roth. Now, if you think right now you're in a really high tax bracket because you're a high earner and you think when you get into retirement, you're going to be living on much lower withdrawals and that your tax bracket will be lower, then a traditional account might make more sense because you'll save more in taxes today than you will in retirement. But again, predicting what taxes are going to be 20, 30, 40 years from now, that's a big gamble. In retirement, you may have multiple sources of income. There could be Social Security, maybe you have a pension, maybe there's 401k, traditional 401k withdrawals or Roth 401k withdrawals, and maybe you have a taxable brokerage account. The more income sources that you have that are considered taxable, the less flexibility you have. Say in a year you have a large expense, maybe it's an unplanned medical emergency, maybe your house needs renovations for a new roof or foundation work, maybe you just want to be generous and gift your family a decent chunk of money. Any large withdrawal from a traditional 401k account can push all those income sources into a higher tax bracket. And it can even affect how much of your Social Security benefit is taxed and how much you're going to be paying in Medicare premiums years down the road. Now, Roth money can provide another option. Generally, when you withdraw from a Roth retirement account, if you follow the rules for it to be a qualified withdrawal, it typically does not increase your adjusted gross income. That can be very beneficial because your adjusted gross income is what the Social Security Administration and Medicare uses to determine how much your Social Security benefit is going to be taxed and what your Medicare premiums are going to be. Now, that's not to say that the Roth is the end-all be-all. There are various things you have to consider. However, it does give you a powerful lever to use to help minimize your tax burden in retirement and help you get the income you need for the expenses you may have without causing a cascading increase in fees what you pay for Medicare and for Social Security. Now, let's talk Social Security benefit. If your combined taxable income exceeds a certain threshold, portions of your Social Security benefit start to become taxable. For 2026, if you're married filing jointly, if your combined taxable income exceeds $32,000 a year, 50% of your Social Security benefit starts to become taxable. Anything under that is considered tax-free income. Now, as you make more and more money, this can go up to 85% of your benefit becomes taxable. Now, this isn't the same as the federal tax brackets, right? So this is just saying at those levels, at those thresholds, your Social Security becomes taxable income, which is then factored into your federal tax brackets, and also you have to pay income tax on it. So the key point is when you withdraw from a traditional 401k, that counts towards your adjusted gross income and can impact your Social Security benefit. Whereas if you have a qualified withdrawal from a Roth account, it does not count towards your adjusted gross income and therefore does not impact whether your Social Security benefit is taxed. This is really important in retirement because say you have an unplanned expense that comes up in retirement and all your money is in a traditional retirement account. Let's say you need to withdraw $40,000 or $50,000 from your traditional retirement account. Not only are you going to be paying higher income taxes because that might put you into a higher federal tax bracket, but now your Social Security income is now also getting factored into your income tax. So the consequences can cascade rather largely. Whereas if you have your money in a Roth, you could pull money out of a Roth and not compromise your Social Security benefit. That's why having a diversified tax strategy is so critical to give you more options and flexibility in retirement. Now, the second issue you need to consider is Medicare premiums. When you enroll in Medicare, your Medicare Part B and Part D can be impacted by your income in retirement. This is commonly referred to as the IRMAA, or Income Related Monthly Adjustment Account. For 2026, Part B premiums start at $200 a month. Now, at higher income levels, that can go anywhere from $280 a month all the way to nearly $680 per month. The first higher income tier for single filers is $109,000 a year. For married filing jointly is $218,000 a year. Now, the taxes are super complicated. This is one of those areas where you really need to reach out to a tax advisor that is well versed in all of these issues. But the important thing to consider is that a traditional retirement withdrawal will impact your adjusted gross income that can impact your Medicare premiums. Whereas a Roth, if done in a qualified manner, generally does not. So, and the other thing to consider as well is that the IRMAA doesn't look at this year's tax return. They look at years prior. So if you have a really expensive income year where you need to withdraw a big chunk of money from a traditional retirement account, it can impact your Medicare premiums years down the road. That's just another thing to consider. Whereas having a Roth, funds in a Roth, gives you a lot more financial flexibility if there's an emergency expense or some large withdrawal that you want income for, that it will not impact or should not impact your Social Security benefit and Medicare premiums. Now, imagine this. You're retired and you have a $100,000 expense come up. Maybe it's a home renovation. Maybe it's a medical emergency. Maybe you just want to gift loved ones a significant sum of money while you're still alive. If you pull that money out of a traditional retirement account, you're most likely going to trigger a higher federal income tax bracket. You could potentially impact your Social Security benefit. And you could also potentially impact how much you're going to be paying in Medicare premiums years down the road. Now, the withdrawal would solve the immediate problem that you need the cash for, but it creates a whole host of secondary costs that you may not realize when you make the withdrawal. Now, if you can pull that money from a Roth, on the other hand, that gives you a lot more flexibility to control what your taxable income is going to be that year and help minimize the impact to Social Security and Medicare. That's not to say that Roth account is some magic account. There's a lot of rules around the contributions, the withdrawals, any conversions you do, and there's still a lot of things you have to take into account when you are looking at a Roth. However, having it does give you a lot of flexibility in retirement. So which account should you choose? Well, the answer is going to depend on what tax bracket you're currently in, how much income you want in retirement, what your other assets are, how much of your contributions are employer match, which is going to be in a traditional, and how much tax flexibility you want later in life. A traditional retirement account may make sense if you're in the higher tax bracket today, or if you're confident that your tax bracket will be lower in retirement. And also that, maybe you just need the tax savings today. And, if you're using those tax savings responsibly. Whereas a Roth account may make more sense if you're in a relatively low tax bracket today, or you just expect that your taxes on your income will be higher in retirement. Maybe you just want more flexibility in retirement and you don't want to risk having extra taxes on Social Security and impact your Medicare premiums. For many people, the answer isn't necessarily all Roth or all traditional. You can diversify and have a portion of your assets in traditional and a portion in Roth. By having a combination in both traditional and Roth, that does give you a lot of diversification for tax purposes. That is the main idea behind tax diversification. Instead of trying to predict exactly what taxes will be in the future, you build multiple streams of income with different tax treatments today. Now, if you already have money in a traditional IRA or 401k, you can convert this over into a Roth. However, this is not a tax-free transfer. The year that you make the conversion, you will pay taxes on that conversion, and it could impact other sources of income by pushing you into a higher tax bracket. So if you have one big lump sum that you transfer over, that could be an often costly decision to make, and it might not be the best move. However, speaking with a tax professional or a financial advisor, they can model out scenarios of how you can roll that money over and when it makes sense and when it doesn't, and what the consequences could be. Often, many people will roll small amounts over every year to stay under certain tax bracket thresholds to minimize their tax impact while still getting money out of a traditional account and into a Roth account for future flexibility. The biggest takeaway is this. A traditional retirement account gives you valuable tax deductions today, whereas a Roth account potentially gives you tax-free withdrawals and more control over your taxable income later in life. Now, mathematically, the best option depends on what tax rate you're paying today and what tax rate you'll pay in the future. But strategically, the best option is the one that gives you the most flexibility. Because in retirement, you're not asking, how much money do I have? You're asking, how much money can I spend after taxes and Social Security taxation and Medicare premiums? If this helped clarify the Roth versus traditional discussion, leave a comment on what account type you use. And for more practical financial advice, consider subscribing. I post a video once a week. Thank you.